Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. So investors tend to get carried away when the times are either too good or too bad, forgetting that nothing lasts forever. Here also we keep talking about what to do, but it's really important to know what not to do, when the markets are either going up or down. It's really important. And we found a beautiful, reference in Peter Lynch's One Up on Wall Street. He talks about stocks mainly, but let's, adapt it to the realm of mutual funds, which can easily be done. So, Dhirendra, what's the first mistake that people tend to do while investing in mutual funds?
Yes, when it comes to investing, everybody tells you how to invest. But what not to do, I think that list is longer. When it comes to what is to be done, there are very few things which you have to get it right. But the learning curve is so long because it is filled with all the kind of things you will be tempted to do. And that looks natural. And here I think Peter Lynch's One Up on the Wall Street is a classic. When it comes to investment books or anything related to markets or finance, it is filled with formula, it is filled with jargon. Here is a storybook which any investor who is interested should pick it up and read it. And it'll feel like if you're a little interested in business or understanding how businesses are run and what is the investment potential, it will be a very easy read. You will be able to relate to things. And the mistakes which are pointed are they are all about stocks, but they're equally applicable on mutual funds too.
Okay, so let's begin with the first one. What is it that investors must not do?
He says about avoid hot, industry. And that is, investors' favorite pastime. Every investor is chasing, and it happens in mutual fund as well. Hot industry, so, right now what is going on is artificial intelligence or something or the other, which is always talk of the town. In India, it has happened with mutual funds as well. If you recall, it started with technology. Before that, it was petroleum and refining companies. And sometimes it is PSU, sometimes it is infrastructure. And investors get carried by that. And because there is some reality to it. But people extrapolate and we lose objectivity. So chasing hot industry can be, translated into chasing recent performance, because it is normally a theme or a sector which is ruling, where investors are making money and people don't really understand. And you normally catch that after it has already done well. You really need to benefit from it. You need to invest before it happens. And if you can't do it, then you have to do something which is repeatable, do something where you can succeed with. The likelihood of success is higher. It's very important for investors that not to get attracted to, hot industry or hot sector or hot thematic funds or hot sector funds and avoid them at any cost. That should not be your initial investing vehicle. And that will always look attractive.
Okay, so the first thing that you must avoid is sectoral and thematic funds. Now moving on to the second one.
Which is, again, a variation of this, which is all the time market is filled with, the noise about the next big thing. The world is changing, and the world actually changes. If you look at last 20 years, the way the businesses are changing. And most recently, it was the startups. And look at the listing of the startups and the companies which, funds which were listing, investing in those. And for a Zomato which has zoomed, you have many other companies where investors invested. And so similar thing where investors invested and lost money, and very meaningful scale of money. And the betting ratio for something which is unknown, which is, you buy into the idea of the next big thing, it is going to change the world, and the world doesn't change that dramatically. And the failure rates are very high. And but one or two success and investors latch onto it. So avoid that. History proves that, when you get attracted to such a thing, the next big thing, the next big thing or the next best thing, it really does not work out most of the time. In case of mutual fund, all the funds which get attracted to such a strategy, they are able to, stack at the top of the pack. And that is where you need to understand that something which is doing extraordinarily well, by concentration. It is not a thematic fund, it is not a sector fund, but some next big thing is getting emphasized in the portfolio. And that is something which should be avoided at any cost.
All right. Now moving on to the third one.
Yeah. Diversification is a good idea. And I think many a times people think that if diversification is a good idea, then diversify very well. And diversifying beyond a point is a useless point. And that is what, Peter Lynch actually coins that expression, which is diversification. It is diversifying for the worse. Yeah. And that is the expression which he has used. And I think, the most recent example is, a few days back, I got a mail that somebody invested 25,000 rupees in a mutual fund. And that was spread over 25 mutual funds. 1,000 rupee SIP in 25 funds. This is on my Twitter timeline. And this is weird. Diversification is good, but this much of diversification is madness. And it is not going to help you in any way. It is only going to add to the complexity. It is going to add to the lack of interest. Some of them will do well. Some of them will do extraordinarily well. Some of them will do very poorly. And you will not be able to figure out. You will not be interested. I think it's very important for investors to understand what are you doing and why. And you can achieve all the diversification with one fund, at most two funds with a scale of this kind, and more so if you are doing your SIP. So 25,000 rupee in 25 funds, SIP every month is not uncommon. When I look at the portfolios of investors which they maintain at Value Research Online, and they keep sending us their portfolio to analyze and share or give our views, many a times it looks like a collector's thing. You have gone about collecting. Earlier it used to be collection of different funds at different points by NFO. Now many investors are doing IPO, SIP in various funds at different points. And they're on with it, small amount in getting invested. Understand what you are trying to achieve. You are investing in equity. You are choosing some good fund. And if you are investing regularly, that will do it. That will do the job. No point doing this. And doing this, spreading beyond a point, actually drags your performance. You incur the cost of an active management. And you end up sometimes being worse than an index. And sometimes just as, you own an index and incur the higher cost of active management.
All right, then avoid over diversification. You should be diversified, but avoid being a collector. That's what Dhirendra is saying. Now moving on to the next one.
Selling early. Most investors think that because you invested your money for appreciation and it has appreciated, so it is your duty bound to take your money out. They don't understand that, equity is going to be a long-term vehicle which will keep going up. It is not something where it is not an aberration. Sensex started in 1978 at a base level of 100. And today it has crossed whatever level, so it is unimaginable, and it will keep growing up because you have to understand the mechanics of it, the underlying of it. They are businesses, they are growing, they are changing with the times, and some of them are dying, some of them are prospering, some new ones are getting created, and that is the index. And as a result of which, they are prospering and they appreciate, and that is why they will keep appreciating. There isn't a ceiling, there isn't a top line, barrier beyond which it won't.
Right.
You should have a sell strategy. You should have a plan. And if that investment is linked to a goal, take your money out. If that investment turns bad, it is no longer as good when you got started, sell it, move that money elsewhere. If that your money has appreciated, very well, it has become very sizable. You have done it for the last 5, 7, 10 years, and you are getting jittery, you are getting scared, then maybe take some money out and put, do the rebalancing. Put 25% into fixed income. These are the reasons to sell, change, realize it completely. But these are reasons internal to you. These are not because the market has gone up. Because if you think that the market is high at 75,000 or 70,000 or 65,000 or 60,000, then you would have lost all these upside just because it was, fearful of the height is a bad plan. And that should not guide you. You should sell. You should have a plan. Rebalancing, a fund turning bad, or your money has appreciated enough that you can go and buy your car, put the down payment for your house. If it was directed for a goal, do it.
Okay, so don't sell too early. Be mindful of your own goals. If you've achieved your goal, might as well sell it, but not because market is at a certain point. Moving on to the last one.
Investors believe very deeply that they can time the market because market is either going up very dramatically or it has gone down very dramatically, and it is dramatic all the time. So, and most investors think that they can actually perfectly time it. After it has come down, you can really buy it at this point, and if it goes up, then you will really be able to ride the big gain, and you don't have to go through the pain of seeing your money going down and going up. It is theoretically right. You can look at the past, the graph of the Sensex or any stock or any mutual fund over the last 5, 7, 10 years. And say, if I would have bought at this point, and if I would have sold it at this point, I would have made so much more money than the fund manager himself. But the point is that it is very easier said. Absolutely impossible to do. Most fund managers have not been able to do it. In my 30 years of watching mutual funds every day, I have figured that no mutual fund manager has been able to call the market. They were broadly right, but whether you can actually precisely time it, that okay, the market has bottomed today, or the market has peaked today and it is ripe for a huge correction, it never happens like that. Not only that, the psychology is against you. If you sell and the market goes down, it becomes impossible for you to get back into the market again. And that might be absolute luck, or that there could be hunch combined with luck. And after that, you will lose one of the biggest opportunity, because once the market turns around, it will not, you will not get a notice. Likewise, if you sell at the peak and after that market comes down, is one. If you actually, try to time the market at the bottom and you invest a large sum of money and market is on a free fall and you think that the market has bottomed, and after that normally the market falls are very steep. So after it has gone down by 20%, it goes down by another 10%. The likelihood is that you will be so nervous after that 10% decline after you have invested that you will take that 10% loss and walk away. And that's the way investors actually make their losses, notional losses, permanent. So don't try to time the market. Choose a good fund, choose a good company, choose a bunch of good stocks or a few good stocks or funds, and be at it, stick with it, and control things which are in your control, which is your time frame, your asset allocation, your rebalancing, your diversification. These are things which are, because markets are never in a state which is permanent. It is either going up or going down, and if you get lucky with one or two perfect timing, it will give you which will be pure accident, and you will get this false sense of magic.
You can predict them.
That you are the magician, and you will be deprived of some of the biggest moves, because most big moves happen when you least expect it. They are a surprise.
All right, so don't try to predict the market. Now, that's all that we have in this episode. There's a viewer's question. Manjunath, who is 42 years old, is seeking advice on rebalancing his portfolio for the next 8 years. He's wondering if he should choose hybrid funds. He can invest a total of 50,000 rupees every month, which includes his existing SIPs of about 78,000. Now, how much can he expect to earn at a minimum with the new money that he's planning to invest?
8 years is very difficult to guess that how much return to expect. But new money that you're going to invest for 8 years, and that too steadily, I'll be very happy if I'm able to earn 40% or 30% more than what I will earn in a bank deposit. And that will translate into something like, if I'll earn 7.5% in a deposit or a risk-free return, then 10%, 11% will be considered a decent return. His return will be optimized also because he will be doing his SIP. By averaging, you are able to optimize your return a little bit because you catch some lows and highs, and you don't get stuck to a high. That's the kind of return to expect. About rebalancing and choosing hybrid fund for your long-term investment, it's a good idea. And more so once you have accumulated something. If you're getting started, then maybe, just to acclimatize yourself with equity, that would be a good idea for a year. Here, if you have accumulated something sizable, and now here is an incremental investment, and this investment you want it to be a little more conservative, it may not be a bad idea. It has embedded rebalancing. You will not be disappointed with the intermittent declines. And those intermittent declines are very, they're scary for investors. After you have accumulated something sizable, you have now, with your great difficulty, with great discipline, with small investments, you have done it over the last 10, 15 years. You have accumulated 50 lakh rupees. And that 50 lakh rupees, if the market goes down by 10%, you lose 5 lakh rupees in a week. That's the kind of thing which scares people. This is where after you have built something, it is a de-risking strategy. That will also go down, but it will not go down that badly.
Okay. All right. So hope, Manjunath, you've got your answer there. That's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.